just recently you said you think it's best now to leave rates where they are. Earlier in the year, you were a little more willing to say maybe another rate hike, but now you say no. Low unemployment's not going to lead to higher inflation. It's surprised to the downside. We're stuck in the St. Louis Fed's low growth regime. But Jim, jobs keep growing. You know, unemployment, excuse me, the GDP has rebounded. It's above trend again, and some people think it's going to stay there. Maybe not. Is one more rate hike this year a problem?
Yeah, I think the FOMC's been surprised by inflation coming into the downside during the spring here, and not by just tiny amounts, really kind of by a large amount compared to the progress that we made through 2015 and 2016. So if you look at the charts, we were creeping up toward 2% all during 2015, 2016, and in 2017, most of that progress has been undone. And I think that's, at least in my mind, leading to a reevaluation of our story about whether, you know, our policy is leading inflation back toward target or not, and so we'll have to see how the data comes in the second half of the year on that.
So are you just saying then let's just wait for the data, and if it's stronger by the end of the year, I'd be in favor of a rate hike?
Well, I'm willing to. Of course, we're always data dependent. I'm not too optimistic that we're going to have higher inflation measured on a year-over-year basis by the end of the year. If you look at the SEP, I think we're still predicting about 1.6%. For core inflation by the end of the year, and so we'd still be sort of well below target and not too far from where we've been in the last couple of years. So I think we've got a ways to go here on inflation.